Have you ever felt like you're playing a game but someone else knows all the cheat codes? I mean, you save your money, you invest, you work incredibly hard, but that financial scoreboard, it just refuses to move. What if I told you it's because you've been taught the rules of money, while the wealthy, they're playing by a completely different set of laws? Okay, let's get into this.
And this right here is the frustration for so many of us. You do everything you're told, right? Save 10%, max out the 401k, climb that corporate ladder, and yet real financial freedom feels just as far away as it ever did. It feels like you're not on a path to freedom. You're on a financial treadmill, and someone just keeps cranking up the speed.
So why? Why does this happen? Well, it's because the system you were taught is designed for slow, incremental progress. But the wealthy, they get it. They understand that money operates on these fundamental, unchangeable laws, kind of like gravity. And once you understand these laws, you can make them work for you, not against you.
See, rules can be bent, they can be changed, and let's be honest, they often favor the house. But laws? Laws are universal. You don't have to like gravity, but you'd be pretty foolish to jump off a building, right? It's the exact same with money. The wealthy don't fight these laws. They build systems to ride them, creating this insane momentum that the rest of us can only dream of.
Okay, so it all starts with exposing the biggest lie we're told about how to get rich. It's a lie that tricks us into valuing the absolute wrong thing, and it's the foundation of the very first law of money.
So, law number one is this. Money loves speed, but true wealth loves time. We are all conditioned to chase those quick wins, right? The fast cash, the immediate results. But that's a trap. Wealth isn't built in a day. It's grown over years by making one good decision and then letting the most powerful force in finance take over, compounding. That's where your money starts making its own money, and then that money starts making even more money. It's like a tiny snowball that eventually turns into an avalanche.
Let me tell you about the tortoise and the hare of real estate. I knew this flipper, an absolute machine. Flipped 100 homes in 5 years, always moving, always chasing the next deal. And yeah, he made some decent cash. But his friend, let's call him the holder, he did something different. He bought one property, then a 4-unit, then a 20-unit building. At the end of those same 5 years, the slow holder's net worth was 5 times higher. Why? He wasn't working for speed. He was letting time do all the heavy lifting for him.
And this just brilliantly illustrates what the greats know. Your single best partner in building wealth isn't some hot stock tip. It's time. I mean, look at Warren Buffett. From 1965 to today, his company compounded at nearly 20% a year. You know what that means? For every single dollar invested, he turned it into $50,000. Let that sink in. He didn't do it day trading. He did it by buying great companies and just letting time work its magic.
So if time is our greatest partner, what are we building with it? This brings us to law number 2, and it's all about understanding the real goal of the game. It's not about earning a huge income. It's about what you own.
All right, law number 2. Cash flow keeps you alive, but equity is what makes you wealthy. Think about it like this. Cash flow is the fuel for your car. You need it every single day for gas, for groceries, your mortgage. It's essential just to survive. But equity is the car itself. It's the asset that holds value, the thing you own that ultimately gives you the freedom to go wherever the heck you want. And what is equity, really? It's simple. It's just your slice of the pie. It's ownership. You can own the whole pie by starting your own business, or you can buy slices of other people's pies by investing in stocks. Either way, the goal is to stop trading your time for dollars and start grabbing pieces of assets that grow over time. Now check this out. This reveals the secret behind one of the biggest brands on the planet. You think McDonald's is in the burger business, right? Well, that's their cash flow. It makes them rich for sure. But what makes them wealthy is their equity. The real money, the empire, it comes from royalties and, get this, their massive real estate portfolio, worth over $45 billion. They sell burgers to buy property. They trade cash flow for equity. Okay, so we know our goal is long-term equity, but how do the wealthy speed this up? Well, they use 2 incredibly powerful tools that most people are either unaware of or, frankly, too afraid to touch. This brings us to laws 3 and 4, control and leverage.
Just take a look at the Forbes 400 list, the wealthiest people in the world. How many of them got there on a salary alone? 0. Goose egg. Not a single one. A full 90% are buyers and builders, people who are constantly acquiring and growing assets. This leads us right into law number 3. The person with the capital has the control.
So, law number 3 is absolutely crucial. He who gives the money has the power.
When you're the buyer, when you're the investor, you control the terms. You're the one who unlocks the value. Think about it. Facebook bought Instagram for $1 billion. It's now worth over $45 billion. The buyers captured almost all of that upside. Being a buyer puts you in the driver's seat.
Now let's talk about the supercharger for this strategy, leverage. This is law number 4, and it multiplies everything. Look at this simple example. You buy $1 million house with all cash. The value goes up 10% in 3 years. You made $100,000, a 10% return, not bad. But what if you use leverage? You put down just $200,000 and get a loan for the rest. The house goes up by that same $100,000. But because you only put in $200,000 of your own money, your return isn't 10%, it's a mind-blowing 50%. Same house, same price increase, but 5 times the return. That is the power of using other people's money. Leverage is one of the single biggest engines of wealth creation, and the wealthy understand how to use it to blow up their wins without blowing up their personal risk.
So we've got the goal, equity, and we've got the tools, control and leverage. Now we need the strategy. This is about how the wealthy think about risk and reward in a way that is completely different, allowing them to win big while protecting their downside.
Let's move to law number 5. You have to hunt for asymmetric risk. This chart basically shows how venture capitalists operate. They know most of their investments are going to fail. They might lose 100% on a few deals. But they're not playing for small wins. They are looking for that one investment that returns 10 or even 100 times their money. That one massive win pays for all the losses and then some. Their upside is basically unlimited, while their downside is capped at what they put in.
But, and this is a huge but, this hunt for massive upside has a critical safety rule. This is law number 6. Don't bet the empire for a pot of gold. The goal isn't just to win big. It's to make sure you never, ever get taken out of the game completely.
And this brings me to a painful story, but it's an important one. A friend of mine saved for 15 years, scraped together over $700,000. He was introduced to an oil and gas deal that looked perfect on paper. So he went all in. He bet the entire empire. And 2 years later, the deal collapsed. Every single penny was gone. 15 years of work vanished. The lesson here wasn't about whether the deal was good or bad. It was about the size of the bet. You never, ever risk what you cannot afford to lose completely.
So how do we put all these laws into practice? How do we use time, hunt for equity, keep control, use leverage the smart way, and manage risk? Well, let's distill all this down into a simple, actionable checklist you can use for any investment decision you ever make.
Here are 5 simple questions to ask yourself. 1. Does this have the real potential to compound over time? 2. Who has the control here? Is it you or is it someone else? 3. What's my worst-case scenario? If this goes to 0, can I live with that? 4. Is the potential reward massively, and I mean massively, larger than the risk I'm taking? And finally, the most important question of all, which is really law number 7, do I actually understand how this works, or am I just gambling?
Now that you know the laws, the real question is this. Are you going to keep playing by the old rules, the ones designed to keep you safe but stuck? Or are you ready to start playing to win the game? The choice, as always, is yours.